Good afternoon. My name is Tim Nyland, and I'm the Managing Director of Professional Services here at Zacks Investment Research. I'm also one of the portfolio managers and equity strategists who builds and maintains model portfolios here at Zacks. I've been with the business for over 25 years. I'm the designer of the Zacks equity valuation model, along with many of the popular tools and features across our lineup of institutional and advisor services. I do want to apologize in advance. I've got a nagging cough that may flare up. Please bear with me. I'm going to do my best to suppress it, but I've been fighting this off for the past several weeks. I also want to acknowledge again that this webinar is being hosted for existing advisor tools and Zacks Research System clients. And I want to extend a thank you to each of you for taking time out of your busy days to attend this webinar. As we were in 2008 and 2010, we find ourselves in really uncharted waters. The nice thing about the analysis that I've put forward for everyone today is that we're going to keep this really simple and to the point. The objective today is to discuss how we're going to maximize returns relative to the S&P 500 while we minimize risk without having to be career analysts and seasoned stock pickers. We really do not know how long this recession is going to last. No one does. And I think that everyone would do themselves justice to take everything that they read and hear kind of with a grain of salt and just put it in your knowledge bank and do your best to process everything that you're hearing out there. I want everybody to also be aware that the tilts that I'm going to discuss today are applicable to any core equity portfolios. They do not have to be applied solely to the earnings certain portfolio, but as you will soon find out, the earnings certain portfolio was specifically designed for the environment that we are in. To go ahead and get started, I want to pick up where we left off in our last webinar. So this is number 2 in the series of the earnings certain portfolio webinars. Later on in the slide deck, I'm going to have a link to the original webinar that anyone new to the call series can click on once they receive this slide deck and view the original webinar. Just to give a little background here, this again was a strategy call slide that I utilized back in December of 2019, where I was showing the first shot across the bow and the need to begin preparing for at least another recessionary scare. And what you're seeing is all of the 10-year, 2-year treasury yields converge right before recessions tend to hit. And this has been indicative of being able to be a really good predictor of recessions for each of the 7 prior recessions. So the idea here is that we always need to be ready for black swan events, and that is what a good core equity portfolio will do for you. This is basically an updated screen capture. Again, this particular chart and the one that was on the screen prior was produced in Advisor Tools. And the idea here is that you can see with COVID-19 outbreak and pandemic, we literally took the yields and the spreads themselves to another level. And the Federal Reserve's buying of treasuries and corporate bonds and everything else that they did was literally quoted, and I quote, as much as deemed necessary. So we really pulled out all the stops. So the idea, before we begin talking about how we're going to position ourselves in this environment, is we really have to have an idea of what happened and how these global governments have responded. Not only the global governments from a fiscal perspective, but also from a monetary perspective, the U.S. Federal Reserve. I've got a chart on the screen. Our chief economist and head equity strategist, John Blank, does work with BCA Research. And this is a graph that they've supplied to us. And you can see that the global governments are literally responding more aggressively to this pandemic than was even remotely close during the global financial crisis. So the amount of fiscal stimulus being pumped into the global economy is just unprecedented. For those of you that are interested, I actually have the expanded BCA Research slides that show the individual countries' fiscal stimulus as well as monetary stimulus that I can make available. All you need to do is just email email us and request it. Literally $8 trillion in global fiscal stimulus as of last week. The U.S. Federal Reserve has also added almost $2 trillion to its balance sheet, taking it to almost 30% of GDP. And for those of you that were watching closely, the U.S. Federal Reserve also nearly, bailed out the entire corporate bond market with all the purchases, bringing the bonds back up to par value. So we need to look at why the market has rebounded. And again, we keep hearing, don't fight the Fed, and it's true. But it's more like don't fight a coordinated global government stimulus combined with all the global central banks pulling out all the stops. And we've literally, in the U.S., we've literally pulled out the bazooka. So again, we're in uncharted waters, and we're going to keep this analysis very simple. So how do we actually beat the S&P 500 in this risky environment? I've got 3 tips for everyone to start looking at, and this is not only now, but just keep a pulse on this ongoing. The very first thing you want to do is know your competition. What is the market cap weighted price performance biases that are baked into the S&P 500? In a few minutes, I'm going to show you a Zacks link spreadsheet that I use to monitor market cap biases. And these biases not only exist for price performance, but they exist for earnings revisions. They exist for valuation. So when we talk about, the S&P trading at a year forward handle of 19 to 20 times earnings, it's really important to understand what biases are baked into the S&P 500 for you to begin to position and tilt your portfolios accordingly. The next thing I'm going to recommend is we need to know what the market cap weighted price performance is for each sector. This can be extremely valuable. If you know what your sector exposure is for your core portfolios, then you can look at the price performance of some of these other sectors and position your tilts accordingly. I have examples of everything we're going to walk through here in just a minute. And again, I already mentioned knowing your existing core equity sector exposure. The idea with these strategic tilts that we're going to discuss is that we want to gain alpha over time, right? This is a slow process, and it really doesn't take much. Tilts can be made very strategically, very small, and can have a very large impact over time, and that's the idea. On the screen, we're leading into our first tilt strategy, and in doing so, I wanted to show you a Zacks link spreadsheet that I put together, and I can make this spreadsheet available to anyone who wants it. I can go ahead and just send it out with the slide deck to everyone on this call. And the idea here is when you open up the spreadsheet, just choose not to update it if you don't have Zacks link. If you would like a trial of Zacks link, all you need to do is ask your sales associate, and that would be something that they would be more than happy to assist you with. But the idea is I have a spreadsheet with all 500 stocks in the S&P 500. I have their market cap. And throughout this presentation, we're going to be looking at daily price performance from February 20th of 2020 through April 24th, which is last Friday. And we're going to be looking at price change. So this is a very, very simple analysis. Where we're going with this particular slide is that I sorted the market cap from highest to lowest. And you can see the top 5 names up there: Microsoft, Apple, Amazon, Alphabet, and Facebook. And what I want you to do now is just focus on the cells I9 and K9 that are highlighted in yellow. And you'll see that the top 5 names in the S&P 500 also represent, in terms of market cap weight, the bottom 355 names in the S&P 500. Now, again, this has implications across the board for how you are going to effectively tilt your portfolios if you expect to effectively downside hedge your portfolio against another downturn, say COVID makes a return, or for whatever reason we get some sort of social unrest that Jeff Gundlach is calling for, and markets turn negative. You're going to need to know that there is a tremendous bias baked into the performance of just these 5 names versus the remainder of the bottom 355 names. Okay, so keep this in mind. We're going to build on this concept. Here's the real problem. The real problem is if you pull these 5 stocks into the Zacks research system and create a market cap weighted composite of the 5 stocks, in this case I did this last night and I called it Megatech, and you'll see that from 220 to 424, this group of 5 names is only down 6.3% on a market cap weighted basis. And you can see that the IVV is still down roughly 16.4% over that same time period. And so that tells us that we've got real issues down below with companies that have just literally been taken to the woodshed throughout this pandemic. So again, the idea here, the top 5 mega cap technology stocks have led the S&P 500 rebound. This is really important. Let's take another look at some sectors, and let's look at the top performing S&P 500 sectors from 220 to 424. You'll see that healthcare, consumer staples, consumer discretionary, and IT, look at IT down 12.7 still, have all outperformed the broader S&P 500 ETF. So these are the sectors that are pulling the S&P 500 higher. And keep in mind that just the top 5 names that represent the bottom 355 names in terms of market cap weight for the S&P 500 are only down roughly 6%. The other thing I want to make mention of and everybody be aware of is that healthcare, consumer staples, consumer discretionary, and technology, if you sum the weights of those 4 sectors from the earnings certain portfolio up, those winning sectors represent 76% of the earnings certain portfolio. They always have and will likely continue to be. So the idea is if we look at this sector comparison of the earnings certain portfolio versus the S&P 500, this is something that can be easily done with your own core equity portfolios. We utilize the Zacks Portfolio Monitor, which is a facility inside ZRS that does this for portfolio reporting. We are in the final stages of getting the Advisor Tools portfolio reports completed, and we'll have those out shortly. But this is something that you can easily do for any core equity portfolio to make this analysis. Look at what your weights are in discretionary, in consumer staples, in healthcare, in technology, and tilt accordingly. The advantage that we have with the earnings certain portfolio is not only do we have an overweight in consumer discretionary, a massive overweight in staples, and a massive overweight in healthcare, but we're taking only the cream of the crop names out of each of those sectors. We're not being dragged down with the rest of the garbage names in the S&P 500. We've got the most earnings stable names in discretionary, in staples, in healthcare. So if those sectors have outperformed the broader S&P 500, then surely the stock picks within the earnings certain portfolio are going to crush the S&P 500, and that's what we're experiencing. And we'll get to the stats on the performance side when we get further down in the deck. So the first tilt is to not ignore the mega cap technology space, and specifically these 5 names. A technology tilt of these 5 names is definitely warranted to stay ahead of the S&P 500 at this point. And it's warranted not only from if the market continues to rise higher, these are the names that are going to thrive on the other side. But if we take another downturn, these names have already proven to be the names that are going to lead us back to recovery. They've already done it once. So it's like the old days, and I know everybody remembers this, where if you didn't have exposure to Apple, you were literally lagging the S&P 500. Now it's kind of like if you don't have exposure to at least the majority of these names, you're going to struggle keeping up with the S&P 500 on both the upside and the downside. Now, the interesting thing is that we actually beat the S&P 500 with the earnings certain portfolio, and we have none of these names in the earnings certain portfolio. So the idea is, if you want to now outperform the S&P 500, begin thinking about tilts such as this. And also keep in mind that Microsoft, Apple, and Google, the A-class shares, are all candidates for me to add into the earnings certain portfolio. And I'll show you what the price and earnings trend over the past 25 years for the market cap weighted composite looks like out of ZRS here in just a few minutes. So that's tilt number one. The next thing I want to do is I want to start working on tilt number two. And tilt number two is one that I get questions about all the time, because everyone is aware that the small cap names can really provide a ton of alpha if timed properly. And it's true. You definitely want to take a look at owning these names coming out of a recession. However, how have the bottom, in other words, the smaller cap names of the S&P 500, how have they fared over this pandemic from 220 to 424? I'm going to send you this spreadsheet. Literally, all I did was scrolled all the way down to the bottom. Remember that I have a descending sword on market cap here, so I just literally grabbed all of the smallest market caps that would fit on the screen. I didn't make this up. Take a look at the price changes, okay? Negative 45%, 67%, 13, 49, 33. I mean, these are just these companies, the small companies. It was literally sell now, ask questions later, and it's still that way. This is performance as of 424. Okay, they're not performing. Okay, so an idea for an excellent tilt would be to add some smaller cap exposure on the way out of a recession. Okay, these small cap names, they will rebound, and they will rebound hard, but I think that we're probably still a little bit too early in this game. I'm going to keep coming back to the point where if you read the Wall Street Journal, you listen to CNBC, you listen to the media, you've got half the people sitting on the fence that, yeah, we're on our way out, we're going to reopen the economy, and this thing is going to get roaring. And then you've got the other half of people and Fauci and everybody else saying, we're going to be in for a second wave of this thing come the fall. I just heard again this morning on CNBC, they're talking about earnings being a drag all the way into 2022 now. So we really need to be cautious when we start wanting to consider some of these tilts that we know we're going to add tremendous alpha. You want to actually see this. Don't try to catch a falling knife. Try to wait for a real turn and real green shoots to appear. Okay. Let's talk about the next area for tilt exposure. And I want everybody to be very clear when I speak of tilt sectors, I'm speaking specifically of the tilt sectors that I remove from the earnings certain portfolio. These are sectors that I never have exposure to in a core equity portfolio, okay? And for this reason, right? We don't know when recessions are coming. We have a really bad time trying to time these markets and these positions. The idea is we want a core equity portfolio that we can more or less put on cruise control and not have to worry about market timing. And that's what you have with the earnings certain portfolio. So specifically, utilities, real estate, financials, and energy have never been in the earnings certain portfolio. And now you're seeing exactly why. Because all they are is a drag on the S&P 500. If you are successful at market timing, these names can be a tremendous asset to building alpha in any core equity portfolio. But if you're not good at market timing, they can really drag your portfolio down, just like small caps. Anybody that got caught holding small caps going into this pandemic got taken to the woodshed. Okay? These are the laggards of the S&P 500. And if we make another downturn, this is not going to change. These are going to remain your laggards. Be aware of these tilt sectors. This is real. Okay? How have the remaining sectors in the S&P 500 performed 220 to 424? We're building on our next tilt strategy here. So the idea is all remaining sectors except materials are leading the S&P 500, and all are in the earnings certain portfolio. okay? If you take a look at the one that's been hurt the most, it's the industrials. And again, the methodology that's been in play with the earnings certain portfolio, and a methodology regardless of whether you use my earnings certain portfolio or your own core equity portfolio, pay attention to your cyclical exposure in your industrial sector, okay? If you're not good at market timing cyclicals, then I would suggest you stay away. And if you're having a hard time identifying cyclical names, or perhaps mutual funds or ETFs that have a lot of cyclical exposure in your holdings, call me, email me. I'm going to give you my contact information. More than happy to do a portfolio review. You can really get crushed holding these names into a recession. If we have another downturn, it could be painful. These companies are beaten down, and they're beaten down for a reason, and yes, they can go lower, okay? This is a chart, and I went through this in great detail in our very first webinar, and in particular, what we're looking at is a 20-year history of price performance of the earnings certain portfolio, and this could be your own core equity portfolio. If we build a composite of your core equity portfolio that's not the earnings certain, I would hope that your core equity portfolio performs similar to the earnings certain. In other words, it doesn't give up as much alpha in the recessions as the broader S&P 500. The idea is if you take the performance of the tilt sectors that I've already mentioned, right? Your utilities, your real estate, your financials, and your energy names out. You remove your cyclical industrials and you remove your material, then you're going to end up literally with, in this case, 6 times the return over the S&P 500. And you're picking up 90+% of your alpha in recessions, right? The rest of the time, you're beating, sometimes you're underperforming. There are times when the earnings certain portfolio will underperform the S&P 500, but you're compounding the gains you're picking up significantly through these recessionary troughs. I talk about this in detail in the very first webinar, and I don't want to get into it more today. But again, here's that link that I was referring to. You're all going to get access to the first webinar when we send this deck out here in a little while. Okay, so again, this is what the portfolio looks like, the earnings certain proxy. We can certainly take a look at the weights of your core equity. If you're not using earnings certain, I'm more than happy to sit down with anybody and go through this. But what I like to do is we strip the tilt sectors out of the core equity. This allows you to sleep at night. If you build the portfolio with earnings stability, your exposure, your overweight and discretionary staples, healthcare, and that tech tilt that we're going to apply is really going to help provide alpha in your portfolio and reduce your risk. So this brings us to the third tilt. Yes, you can use the tilt sectors collectively, but use them sparingly and with conviction, okay? So let me just give you some examples of what I'm talking about. This is something that I preach every time we go into any sort of a correctionary period. Financials, right? Obviously, net interest income pressure due to the structure of the yield curve right now, not good. You have got to have a solid understanding of the loan book of assets before you actually make investments. Bank of America, JP Morgan, these are your best of breed. Owning the XLF or regional banks, I just don't recommend it because you just don't know the contents of those loan books. And you stand to make a lot more alpha going with a Bank of America who's much more traditional bank, much more revenues derived from net interest income in at JP Morgan than you are just saying, you know what, I'm going to go with the XLF because there's a lot of garbage names in the XLF. So, but the other thing I recommend you do, everybody has access to the Zacks focus list that has access to the earnings certain portfolio. It's those two portfolios that are included in the equity model portfolios solution in Advisor Tools. The Zacks focus list is a great resource for guidance on these names if you must own this group. Literally just scroll through the list and see which finance bank names Shiraz Mian, our head of research, has recommended for the focus group, and those are going to be your picks. So the idea when you're looking at financials is you want to try to get in when you expect the yield curve to obviously steepen, spreads widen, banks make more money. The energy sector is a real problem right now. Everybody's aware of this, right? The thing that I want everybody to be aware of is that it's just not a change in demand. This is a monumental shift in demand that's underway. And countries like Russia and Saudi Arabia and others are going to really have a hard time with this. This is going to take potentially years to play out. We all know that U.S. oil producers are not profitable at the $20 to $30 barrel of oil level. So we're going to see consolidation in this space. Wait for the bankruptcies, wait for the consolidation. You're going to want to seek quality research before diving into these names. There is a lot of alpha to be had playing energy names at some point. There is now, if you're a stock picker and you know what you're doing in the energy patch. Shiraz Mian, our head of research here at Zacks, is actually a former Goldman Sachs oil and gas analyst. The Zacks research here, I mean, it's quality research. Look to the long-term recommendations in the Zacks analyst written research. The research that Shiraz and his team puts out is solid. Take your time in the energy space. Don't get in a hurry. This has got some time to play out. Real estate, obviously, REITs, various exposure to retail, office buildings, lodging, entertainment. Look, I mean, we don't know what the office is going to look like post-pandemic. I've heard that prior to the pandemic, 4% of people worked from home. I also heard I read a stat yesterday or the day before that said they expect upwards of 30% or more people will continue to work from home even after the pandemic. This is going to have implications long term. We all know what's going on with retail. In the lodging space, drive by any hotel, there's no cars. Entertainment venues, there's a lot of talk going on about permanent changes that are going to need to be made to stadiums, concert venues for social distancing. I don't know how this is going to play out. None of us do. Just make sure you know the assets that are held and you're comfortable with them before making that investment in real estate, in REITs. Okay? Utilities, anybody who's been on a strategy call with me and we've used the valuation model to value utilities knows that I've never been a fan of utilities. I haven't been a fan of utilities since 2013. And the reason why is that utilities have always been a defensive play. Equity risk premium rises, you get a lot of money that traditionally should get attracted to utilities. And that relationship really broke down in 2013. We had a real precipitous decline in equity risk premium here, and the forward multiple for the utilities literally just kept escalating. And there's literally no growth. You're looking at a little bit better than GDP growth in some cases. I can do a full utility analysis for anybody that's got exposure. Just reach out to me, and we can look at your holdings. There are far better alternatives for yield, and that's something that we can certainly take offline. Just be careful with utilities. They're very expensive, and the price decline that you saw right alongside of the S&P 500 during this pandemic rout is a testament to the fact that utilities have just gone way too far. Investors have chased them from a forward multiple perspective too far relative to growth and relative to their yield. That was tilt number 3. Tilt number 4. This is a topic that's become really popular, and I'm not going to go through all of the generic themes that are out there. I just want to call your attention to a couple themes. The first one is, and themes that I really like, is the 5G telecommunications theme. The reason I love this is it's the easiest theme to play right now. And the reason for this is that very few people are aware that on Monday, March 23rd, President Trump actually signed into law 2 bills designed to basically unveil 5G in the United States. And the easiest way to play this, I've got it outlined right here, is just overweight Apple, right? If you think back to the days that you were in Starbucks or on an airplane and looked around at how many people were staring at their phones, how many of them were iPhones? I mean, these are all going to need to be upgraded to get access to the 5G network. Apple does not offer any 5G phones currently. So we have a massive super cycle coming. And I don't really know how many people are even aware that President Trump signed these bills into law paving the way for 5G. So this is a real opportunity. The other thing that you can do, it's a little bit more complicated but more rewarding than just buying Apple, is you can buy Apple in the 5G supply chain. I've had some conversations with some of our clients already about this. I have a watch list that I like, that I maintain. I'm sharing it here with you guys. Do some research on these names. You can call me. There are some real winners in this space, much more so than even Apple if you play the supply chain. A little bit more sophisticated, but again, this is a thematic tilt number 4 that I'm recommending that you at least be aware of. These are out there, and there are some really good ones. There's some that I really don't believe in, but there are some really good ones as well. The other one that I really, really like is the work from home technology stocks. And you'll see that we're going to come full circle right back to exactly why the top 5 names in the S&P 500 have literally led the rebound. Have you tried to buy a new laptop lately? Have you tried to upgrade your software? Have you finally upgraded to Microsoft Office 365 to get access to all the latest collaboration tools? I mean, I talk to people every day that are going through this. Yeah, I mean, you can't hardly find a new laptop right now, and everybody's upgrading their Microsoft Office. This week, we're going to get a lot of these names reporting, the big tech. Google already reported. Google search is up 4 times during COVID relative to peak Super Bowl traffic. They killed it last night, 13% ad revenue growth. Google Docs, Google Classroom, Google Search. This is an easy thematic tilt, right? We've already talked about the need to get exposure to the tech names, not just any tech names, the top 5, along with any tech names that are obviously in the earnings certain portfolio, okay? Microsoft Office, right? Teams, Azure Cloud, Server, Xbox. Microsoft just inked a deal with Coca-Cola earlier in the week to provide Teams and Azure Cloud services to Coca-Cola, and they are locked in a real head-to-head battle with Slack, and we'll talk about that issue here as our next tilt. Facebook, obviously network larger than Christianity. All of a sudden, they came out with free video calling for groups of 50 or less. Well, where do you think that was headed towards? That was headed towards getting Facebook into the office, into the remote work from home space. What happened to Zoom on Friday? It got smacked, right? So in this thematic tilt that I outlined, I add a real key player to this list that everyone needs to be aware of, and that's Adobe Systems, okay? They literally led the software subscription model with the Adobe Creativity Suite. For those of you that aren't familiar with Adobe, it's Illustrator, it's all the Adobe productivity tools that we use day in and day out. The PDF, they were basically the inventors of the PDF document and everything. So they also have Adobe Connect, Adobe Sign. There is literally nothing that happens on the internet in terms of editorial and web design without Adobe software. And the real key is this last point right down here, is they are becoming a massive player in cloud technologies, okay? So add those to your list if you don't already own Adobe. I own all of these stocks, and I own massive weights in all of these stocks, just for full disclosure. Amazon is one that I've recently picked up just about a month and a half ago. I've already picked up close to a 30% return on it. This doesn't require any explanation, and after the last couple quarters of earnings, they finally fit into my paradigm where I could justify the multiple and the expense, so I went ahead and exposed myself to that. It pretty much needs to be a tilt in everyone's portfolio now. I mean, who would have ever thought that in any recessionary environment that Amazon would be a defensive play? I mean, we're seeing it now. It's one of the top performing names. Apple with Apple Plus, laptops, PC, the super cycle, and 5G phones. App Store with 25% commission overrides or sales overrides on every purchase. I mean, everybody's sitting at home just playing on their phones, buying apps. I mean, Apple's making 25%. We'll see how they report. It's something that you don't trade. I don't care what Goldman Sachs comes out and says, oh, sell Apple because iPhone's going to be delayed a month. Well, who cares? Yeah, it's a problem, but you know what? You don't trade Apple. You own it, okay? Tilt number 5. Avoid the one-trick ponies in favor of the giants. I have spoken with so many clients about this over the past couple of weeks. It's just super, super important to realize that once we get out of this pandemic state where everyone is forced to basically shelter in, these one-trick ponies, some of them are solid, right? But others could be at some significant risk because we all know that money is going to flow from these names to other names. So in order to expose yourself effectively to this technology that everybody's trying to get a hold of, you're better off doing it through a much larger, more diversified organization. And I'm going to give you 3 examples of exactly what I'm talking about. DocuSign versus Adobe. So DocuSign is essentially a one-trick pony. Obviously, it's electronic signature. It's ideal for what's going on right now. However, I've already spoken about how diverse Adobe's business is. So to the extent all of a sudden everybody's going back to work and there's less demand for DocuSign, isn't it a better idea to probably own Adobe where you've still got exposure to all the other technology that Adobe has to offer? The answer is probably yes. Same thing with Zoom, right? So Zoom is a one-trick pony, video conferencing, but guess what? Adobe has Adobe Connect, Cisco has WebEx, and now we got Facebook doing free video conferencing for groups of less than 50, okay? Just be careful. Slack versus Microsoft. These guys are literally locked in a head-to-head battle. Anybody that doesn't believe me, just lift the hood and take a look. And again, this is that 5-year agreement that I just spoke of with Coca-Cola. You got to decide who you're going to put your money on longer term. A lot of these are going to be great acquisition candidates, DocuSign, Zoom, Slack. They're going to be acquired at some point by the larger players, but at what cost, I don't know. It's just, this is a real safety play. The one-trick ponies can give you a ton of alpha, but they can also bring in a lot of risk to your portfolio. I much prefer the diversification play. If you go with Cisco for WebEx, you've just aligned yourself perfectly to the network of 5G, okay? So not only do you have exposure to WebEx for video conferencing, which is one of the premier platforms, but you've literally just entered the race between Huawei and Cisco, and I don't know who you'd put your money on, but at this point, I would put my money on Cisco getting contracts in the U.S. for the 5G network over Huawei, okay? Tilt number 6, let's seriously discuss this one, okay? Because I think I heard Morgan Stanley come out yesterday. I think JP Morgan just came out with a call this morning about the need to start looking at value. And look, I don't disagree with that, but look at it and then take a pause and digest it for a while. Remember that growth never goes out of style, and chasing value can be seriously risky in this environment, right? So there's cyclical names, there's broken growth companies that are going to look really, really tempting right now. And I always speak of this in terms of catching falling knives, right? If we go for a retest of the lows, I'm not saying we're going to, I don't think we will, but if we do for some reason, right? I already mentioned that these stocks are cheap, they can get cheaper. Okay, so you're adding a lot of risk that you don't need to add if you have a proper core equity portfolio and you stick with just some of these tilts that are just very, very obvious if you just look at the metrics and look at where the money flows are going. Nobody knows how long this recession is going to last. The one thing that I do recommend everybody really pay attention to is utilizing the Zacks equity rank, and this is obviously easily accessible through advisor tools and the Zacks research system. Any companies that are about to make the turn in terms of EPS revisions, and remember EPS, earnings per share, is the lifeblood of equity valuations. We have a predictive model called the Zacks rank that will give you a heads up, if you will, at least for 30 to 60 days, short-term indicator of when we expect that consensus estimate revision to reverse. And that's a really good indicator of where you might want to jump into some of those names. If anybody is having trouble finding cyclical names, wants a list, anything, just reach out to me. I'll show you where they're at in Advisor Tools. You can contact our support desk. They can help you. They are in the focus list section of Advisor Tools, and I'll show you here where that is. Okay, what I want to do now is I want to just remind everyone what an ideal core equity portfolio looks like from a price action and earnings perspective, right? This is a trailing 4 quarters earnings line. Ideally, if we were to create a composite of your core equity portfolio, if it's not the earnings certain portfolio, you would want your earnings to be stable, and you would want them to basically go through recessions virtually unscathed. Okay? We do this by building the 75 stock portfolio. We stick to very, very strict rules in terms of earning stability, length of history, the quality of the fundamentals. There are no tilt sectors ever in our core equity position. This is what it looks like visually. This is really important. If we do the analysis further in our Zacks research system, that's where this price and earnings chart comes from. We can actually take a look at the EPS, the underlying EPS revision history from a composite perspective. We can see that the earnings certain portfolio, given this route, is really only down 12.8 from a year ago's forecast, which isn't bad. FY2 is only down 9.9. You take a look at what the S&P 500 ETF, the IVV, looks like fundamentally. It's fairly stable up until the point where you hit recessions, then you get these dips, and that's what really drives this volatility that we're all trying to avoid. You can see the Fed came in here and saved the day, but we've still got real problems with EPS revision over here. This is how exposed your clients are to these troughs, and this is what we try to avoid with core equity positions that are solid. This is what the S&P 500 ETF, the IVV, looks like fundamentally. Not many people can actually see this, but you have to have the composite facility and Zacks research system to do it. But the market-weighted average stock in the S&P 500 is literally down negative 27% from a year ago. So that's, a solid 2 times lower than what we're experiencing in the earnings certain portfolio. So it's no wonder the earnings certain portfolio is outperforming the S&P 500 in this time frame. Same thing with FY2, it's down 17%. I actually created a composite last night of the Megatech group. This is the top 5 stocks. This is your competition, everyone, right? These top 5 names in the S&P 500 represent the equivalent weight of the bottom 355. Take a look at this earnings line. If we're going to beat the S&P 500, we've got to have some exposure to these names, because these names are literally carrying the S&P 500. The S&P 500 is a tough benchmark to beat because of the biases built into the benchmark. You've got to be aware of this bias. This is how tough the S&P 500 is to beat, because you're competing against the top of the top technology names in the world. This is what it looks like fundamentally. The top 5 names are only down 10% from a market-weighted average from a year ago. That's incredible. FY2 is only down negative 3.4. That's your competition. That's where you need exposure. Okay? I've said this a few times. I want to say it again, and I'm going to give this deck there once you've got these email addresses, phone numbers. If you want to see what your core equity portfolio looks like fundamentally, I would be more than happy to have either myself or my team build these composites for you of your portfolio. All we need you to do is send us an Excel spreadsheet with tickers in column A and shares in column B, and we can turn those around literally the next day, have a review with you and kind of show you what your portfolios look like visually, which is something that is of huge value, and kind of go through it with you. So more than happy to do that. These are the contact information you can send those requests into, and we'll get back to you within a day with a time for a review. Okay. So let's take a look at excuse me, some performance of the earnings certain portfolio versus the S&P. These are obviously updated numbers since the first call. We're now looking at a 5.4% beat over the 220 to 424 time frame over the S&P 500. Equal weighted average stock down 11%, and the earnings certain IVVs down 16.4. If we take a look at Noble, there's a huge part of the presentation I do on Noble. I'm not going to go through it now, but Noble's another one that's a really, really popular ETF of aristocratic dividend names. We do that as well with the earnings certain portfolio. It's a byproduct of the portfolio. We're beating Noble by 8.3% on price return from 220 to 424. Okay. Where do I find this information in Zacks Advisor Tools? For entitled ZAT users, again, all you do is go to your equity model portfolios, earning certain portfolio, and focus list that I referred to is here. Keep in mind for existing clients, obviously everybody's an existing client on this call, you may already have access to the earning certain portfolio through these equity model menu. If you do not, contact your sales rep and discuss an upgrade. Again, depending upon the service level, it's included at some levels. Otherwise, you have to pay an additional $1,200 or so to get access to it, and that's per year. So they'll be happy to discuss your options at that point, depending upon what service level you have. In the Zacks research system, all of the proxies can be found just by clicking on the magnifying glass and going to custom composites and scrolling to the bottom. It's Zacks earning certain proxy right here. Okay. Anyone who's interested in upgrading from Advisor Tools or perhaps keeping Advisor Tools and bringing on the Zacks research system, which is our institutional platform that you've seen a ton of charts where we build composites and all sorts of things, that can be done very reasonably as well. Just reach out to your sales representative. Again, so if you're interested in the earning certain portfolio, it has several use cases. I'll just review very quickly. You don't have to take the entire earning certain portfolio as your core equity portfolio. You can literally just use it as a list. If you combine the names in the earning certain portfolio with the focus list, you've literally got the cream of the cream, you know, top 120 or so names in the S&P 500 that are most likely to outperform in any market. So really, really important. My contact information, as always, is here. I'm always willing to talk to clients, prospects. I'm always here. Feel free to reach out to me anytime. And I want to thank everyone for attending, and also emphasize again that any of our US-based sales and support team members can speak to the earning certain portfolio, the focus list. Please reach out to us with any questions you have. I'm going to have Adam send the presentation deck and the link to this webinar recording to everyone in attendance. And I want to thank everyone again for your time and attention today, and obviously thank you for your continued support of Zacks. We appreciate it. Have a wonderful day.